Before we talk about where silver might be going, you need to understand what has already happened. Because the last 12 months have quietly produced one of the most unusual asset performance tables modern markets have seen in decades. If you look at the numbers carefully, they tell a story that most people have completely missed. Silver mining stocks have surged roughly 126%. Gold mining companies climbed around 99%. The price of silver itself advanced more than 100%. Gold gained nearly 50%. The broad U.S. stock market, represented by the S&P 500, delivered a return close to 14%. Government bonds barely moved, rising about 1%. And the asset the internet spent years calling digital gold, Bitcoin, is actually down more than 20% over that same period. Pause for a moment and think about what that means. The asset that was supposed to replace precious metals, the asset that was supposed to make gold and silver obsolete, is the only one in that group showing a negative return. Meanwhile, the companies that dig silver out of the ground delivered a gain of more than 100% in just 12 months. But the performance table, as interesting as it is not the real story. The real story is something happening quietly behind the scenes inside the physical silver market. Because the data coming out of the vault system of the world's most important metals exchange is beginning to attract serious attention from traders, analysts, and institutional investors. That exchange is the Chicago Mercantile Exchange, widely known as COMEX. COMEX operates the largest precious metals futures market on Earth. Every day, enormous quantities of gold and silver contracts change hands there. On paper, billions of ounces of metal can trade in a matter of hours. But inside the COMEX vault system, there is a distinction that very few people outside professional trading circles understand. The metal stored inside those vaults is separated into two main categories: eligible silver and registered silver. Eligible silver meets the exchange's standards for purity and storage, but is not necessarily available to satisfy futures delivery obligations. Registered silver is different. Registered silver is the metal that can actually be delivered to someone who holds a futures contract and requests physical settlement. That means if you own a futures contract and decide you want the real metal rather than a financial payout, the bars that come from the registered category are the ones that matter. And recently that registered pile has been shrinking fast. Over the last 30 days alone, more than 11 million ounces of silver have quietly left COMEX vaults. That may not sound dramatic at first, but when you look at the scale of the remaining supply, the picture changes quickly. Because the total amount of registered silver sitting inside the vault system is now roughly 79 million ounces. 79 million ounces may seem like a large number until you realize that the global silver market consumes close to 1 billion ounces every single year. That means the silver currently registered for delivery on COMEX represents less than a tenth of annual global demand. Now consider the structure of the futures market layered on top of that supply. The number of outstanding paper contracts tied to silver is enormous. These contracts represent financial exposure to silver, but they do not necessarily correspond to physical bars sitting in a vault waiting to be delivered. When analysts compare the number of open paper claims with the amount of registered metal available for delivery, they arrive at a remarkable ratio. Today, there are roughly 7 paper claims for every single ounce of silver available for delivery. 7 claims, 1 ounce. That ratio does not automatically mean a crisis is about to occur. Futures markets have always functioned with far more paper claims than physical inventory. Most contracts are closed before delivery ever takes place. Traders buy and sell exposure to price movements without ever intending to take possession of actual metal. But ratios like this have historically appeared during periods when the physical market begins to tighten. And trader behavior has started to reflect that possibility. During the final trading days of the March silver contract, something unusual occurred. Instead of closing positions or rolling them forward into the next contract month, several market participants made a different decision. They stood for delivery. In a single day, more than 1.3 million ounces of silver were requested for physical delivery through the exchange. That decision tells us something important. Not about price, but about confidence. Someone looking at the numbers decided they would rather hold physical silver today than rely on a paper claim tomorrow. That signal is beginning to appear outside the futures market as well. Earlier this week, a photograph began circulating across financial networks and social media platforms. The image was simple. It showed the front window of a jewelry store in Turkey. There were no charts, no analysts, no complex financial explanations. Just 3 handwritten signs taped to the glass. The first sign promised that what the shop owner was saying was the absolute truth. The second sign said something remarkable: 28 years as a jeweler, first time there is no gold. The third sign was even more striking. If we had it, we would be selling it. That single photograph captures something deeper than any spreadsheet or economic report. Because when people begin losing confidence in paper currencies, they do not rush to buy financial derivatives. They buy tangible assets. They buy things they can hold in their hands. Throughout history, that instinct has led people first toward gold. And when gold becomes expensive or scarce, attention often shifts toward silver. Silver has always occupied a fascinating position between money and industry. For thousands of years, it circulated as a monetary metal alongside gold. Entire economies were once built on silver coinage. At the same time, silver possesses unique physical properties that make it indispensable in modern technology. It is the most electrically conductive metal known to science. That characteristic makes it extremely valuable in electronics, renewable energy systems, advanced medical equipment, and military technology. Solar panels require silver to conduct electricity efficiently. Electric vehicles rely on it for electrical connections and control systems. Smartphones, computers, and countless electronic devices contain small quantities of silver embedded inside their circuitry. Individually, those amounts are tiny. But when billions of devices are produced every year, the total demand becomes enormous. This combination of monetary history and industrial necessity makes silver different from nearly every other commodity. Gold is primarily a store of value. Copper is primarily an industrial metal. Silver is both, and that dual identity creates unique dynamics in its supply and demand cycle. The global economy consumes massive amounts of silver each year, yet much of that metal disappears into industrial products that are extremely difficult to recycle economically. Once silver enters certain supply chains, it may remain locked away inside electronics or infrastructure for decades. Meanwhile, mining production struggles to keep pace with demand. Unlike gold, which is often mined as a primary metal, most silver production occurs as a byproduct of mining other metals such as copper, lead, and zinc. That means silver supply cannot always respond quickly when prices rise. If copper production slows because of economic conditions, silver output can fall even if silver prices are climbing. This structural limitation has created repeated supply deficits in recent years, demand exceeding new production. And as the global transition toward renewable energy accelerates, the pressure on silver supply may intensify even further. Solar energy alone has become one of the largest sources of new silver demand. Each solar panel requires a small amount of silver paste to conduct electricity generated by photovoltaic cells. Multiply that by millions of panels installed across the world every year, and the numbers become staggering. Electric vehicles introduce additional demand through their complex electrical systems and battery technologies. As governments push aggressively toward electrification and renewable energy infrastructure, these industries could consume increasing amounts of silver for decades. When you combine those industrial forces with monetary uncertainty, the result is a market environment that many analysts believe could become extremely volatile. And that brings us to one of the most interesting forecasts currently circulating within the precious metals community. Veteran technical analyst Michael Oliver recently suggested that silver could eventually trade somewhere between $300 and $500 per ounce. At first glance, that prediction sounds extreme. The current price is far below those levels. But the reasoning behind the forecast deserves careful examination. For nearly half a century, silver traded within a broad range roughly between $5 and $50 per ounce. Every major rally eventually failed near the upper boundary of that range. The most famous surge occurred during the late 1970s when wealthy investors such as Nelson Bunker Hunt and William Herbert Hunt attempted to accumulate enormous quantities of silver. Prices exploded upward before regulators intervened and the market collapsed. A similar pattern appeared again in 2011 when silver briefly approached $50 during the aftermath of the global financial crisis. For decades, that $50 ceiling acted like an invisible wall. But in 2025, the market finally broke above it. When a commodity escapes from a multi-decade price range, the next phase can sometimes expand dramatically. The second factor analysts are watching closely is the gold to silver ratio. This ratio measures how many ounces of silver are required to purchase 1 ounce of gold. Historically, that ratio averaged around 15 to 1 for centuries when both metals circulated as money. In modern markets, the ratio has often been much higher, sometimes reaching 70 or even 80 ounces of silver for a single ounce of gold. Recently, the ratio has hovered near 50 to 1, suggesting that silver remains relatively inexpensive compared with gold. If the ratio were to move back toward historical averages while gold prices remain strong, silver could potentially experience substantial appreciation. The third factor is the macroeconomic environment. Since the early 1980s, the global money supply has expanded dramatically. Governments around the world have accumulated unprecedented levels of debt. Central banks have engaged in decades of monetary stimulus, creating trillions of new currency units in the process. Some investors believe this environment increases the appeal of scarce, tangible assets such as precious metals. When currencies lose purchasing power, assets that cannot be printed often become more attractive. Whether that scenario unfolds remains uncertain. Financial markets are complex systems influenced by countless variables. Wars begin and end. Economic policies change. New technologies emerge. Supply chains shift. But when analysts step back and examine the broader timeline of the silver market over the past few years, the progression becomes difficult to ignore. 2 years ago, silver traded around $29 per ounce. 1 year ago, it was still near $28. By late 2025, it had broken above $50 for the first time in history. In early 2026, it surged to more than $120 before experiencing a sharp correction. Today, the market is consolidating near $74 per ounce after that dramatic pullback. Corrections of this magnitude are not unusual during long-term commodity bull markets. In fact, many of the most powerful rallies in financial history have emerged from periods when prices temporarily collapse before climbing to new highs. The question investors must confront now is not whether silver has already moved. Clearly it has. The more important question is whether the current consolidation represents the end of the story or simply a pause before the next stage begins. Because if the structural forces building inside the silver market continue strengthening, declining physical inventories, rising industrial demand, and increasing monetary uncertainty, the next chapter could look very different from anything markets have experienced in the past. And the investors who recognize those shifts early may find themselves positioned very differently from those who ignore them. Financial history is filled with moments when quiet structural changes slowly built pressure beneath the surface before suddenly transforming into powerful market moves. Whether silver is approaching one of those moments remains to be seen, but the data emerging from vault inventories, industrial demand trends, and global economic conditions suggest that the metal many investors ignored for years may once again be entering the spotlight. The only remaining question is how large the next move might become and who will be paying attention when it begins.